Welcome to this presentation of how to add to your position size. This is the Specialist Trading Weekly Forex lesson for the week ending January 13th, 2012. First of all, we'd like to wish everyone a Happy New Year. We just started out the week. We haven't given you a weekly lesson in a while, since last year, since 2011. And we want to wish you all a great year. We hope that 2012 is just as prosperous and as abundant and successful as it was for us in 2011. Now we're going to show you a great technique today to how to increase your position size while trading the Forex markets. But before we do, we ask that you please take a moment to view our disclaimer. I'm going to show you this technique and some performance results from this method, but please remember that we can in no way guarantee that any of these results will be repeated in the future. So take a moment to view our disclaimer, and then we shall begin this week's Forex lesson. Okay, so we're going to be talking about increasing your position size. This is something that has been requested as of late. A lot of traders have been asking me, Steve, do you have any techniques for increasing our size? We have been doing fairly well with your strategies and your methods, but we'd like to increase our trade increase our size as the trade is going on. Now, I have to first admit that I do not trade this way. I've done this in the past when I was on the floor. I used to do this a lot. But my trading has gone away from that. I basically, whenever I trade the Forex or any market for that matter, I usually just buy one position and then, that's it. I'm in that trade for the remainder until I exit. But this is a technique that I have seen and I've used myself in the past. I just don't use anymore. And there are three things, though, that I think you need to know prior to increasing your position size while the trade is going on. And these are three most important things you need to know. The first is you must be adequately capitalized. Secondly, you must be adequately capitalized. And third, you must be adequately capitalized. I say this to make a point because this is really, really bare bones important. You cannot try this type of advanced technique unless you have enough capital, regardless if you're trading the mini account or the full lot size. It doesn't matter. Because of margin requirements, a lot of people think, it doesn't take that much capital to trade this on an intraday basis. But because of increasing your position size, you have a lot of lots, you can really make these much more riskier than they are in the beginning. And that will really, if it goes against you, if you have 2 or 3 losing trades, you'll see your account really decrease very rapidly. So you must have adequate capital, the margin requirements, and then you should also have enough cushion in your account as well, just so that you can make sure if you do go into some type of drawdown, you're able to cover that. So this is a technique I would suggest only for advanced traders. All right. First of all, if you are a beginning student at the Forex course, do not try this. Just simply trade the way we teach you in the webinars, where you should just start out trading one lot and then exit at the standard exit point. But if you're more advanced, you've been trading for a while, and especially if you have enough capital, then you can try this technique. Once again, I have to state that I do not personally use this. I've used this in the past, but currently I just start with one position and then I end it, and that's it. Okay? All right, so let's talk about how we would do this for the Forex traders. Let's talk about looking at a strategy here. It really doesn't matter. We can apply this to any strategy because all we're looking at, first of all we want to find is the setup bar. So let's say this is strategy number 1. It doesn't really matter, but this is the setup bar. All right, so we know that we want to go long. It fits all the requirements to go long, and we're going to be entering if we trade 1 to 5 pips above the high of that setup bar. So that's our entry level, okay? So we wait to see what happens, and once we, trade there 1 pip above on the Australian dollar, looking at a daily time frame, we can see that, well, this works pretty well, so we are long one contract or one lot, all right? Now, immediately after we enter long into the position, we want to protect ourselves, and so we use stop placement number 1. That's where we place our stop 1 to 5 or 10 pips just below the setup bar. All right, so we enter the trade and we've protected ourselves. We only have one lot. All right, we start out with the most basic unit of measurement, just one lot. So we wait for the trade to proceed, and as it does, it's going in our direction since we're long, and we kind of stall here, but now we get up to the 200% range extension. For those of you who aren't familiar with that, it's simply the range of the setup bar, and we just double it, and that's our level. And usually we use this level as our most standard and basic point of exit. We can use this to exit and for a very nice quick trade, and this works out tremendously, this type of exit, because it's a really quick way to get out of a trade with a nice quick trade. You don't risk a lot. And this is a very standard basic way for exiting. But what we're going to do now is something entirely different. What we're going to be doing now, instead of exiting at the 200% range extension, we're going to be entering. We're actually going to be buying another lot. So now we're long 2 contracts. We're long 2 lots of the Australian dollar now, okay? So the second thing we do once we have purchased is that we move our stop to break even where we purchased our first lot. So we originally purchased our first lot in the Australian dollar here, and then we purchased our second at the 200 range extension. All right, so originally our stop was here. We now move our stop up to the original point of purchase where our first buy was. So what this means is that if the trade turns against us, we will be stopped out on the lot we bought up here for a loss, but we will basically break even on the lot where we bought here. So we'll, in a point of fact, be losing what we would have lost in the beginning if we had only traded one and that trade turned sour. Okay? All right, so we have 2 contracts. We're long 2 lots now of the Australian dollar. And so we're waiting for price to continue to head upwards. And now we see that we're at the 300% range extension. Once again, this is a standard point of exit if we're trading our most generic way of trading our strategies, but we're doing things entirely different now. We are actually going to use that as another point of entry. So now we're going to be buying our third lot. So we're along 3 lots now, or 3 contracts of the Australian dollar. And once again, we move our stop up, and this time we move it up to the 200% level. So now we've increased our size to 3 contracts, to 3 lots. And what this means now, once we get to this 3 lot level, we will not have any risk involved because we've moved our stop to the 200%. If the trade turns against us, we'll be stopped out and have a loss on what we bought at the 300% range. We'll break even on what we purchased at the 200% range, and we'll make a nice small gain here on what we purchased right here at the original entry. So we'll break even. We'll have a nice profit here, and we'll have a nice loss here, so we'll basically break even. So we're playing with the house money. Now this is the maximum amount of contracts or lots we'll purchase, 3 lots. So where do we exit? Well, seems very obvious now. Once we get to the 400% range extension, that's where we get out. Okay? Normally, people would say, well, we've been buying at these range levels so far. Do we just keep buying? No, we've seen through our research, and this is basically nothing that's been systematic research, but just on site, that many times when a trend hits that 400% range level, it usually either stops and falters or it turns around entirely. So we would, especially if you're beginning or starting to use this technique, exit all of your position, your entire lots or all your contracts at the 400% range. You shouldn't be long once you get up that 400% range. And I know a lot of traders will say, well, Steve, I've seen it go higher. And sure, you will see it go higher at times, but you'll also see it almost magically get up there many times and then stop. So it's best, especially now when you're learning this technique, to exit everything. Okay? So we entered 1 lot here, the 2nd lot here, the 3rd lot here, and hopefully, if the trend continues up to the 400% range, you have exited everything there. The key point to using this technique is to always move your stop up. Your original stop is here. As you get to the 200% range, you move it here, and then so on, up all these levels until finally you exit the trade. Now, points to remember. I cannot stress enough that this is for advanced traders only. If you're new to trading the Forex, this is not something you should be using. You should be trading basically the way I trade. I've been trading for nearly 35 years, and I only really use just one standard set of lots. You know, I have my one position, and that's it. I'm not going to add to my position at all. So if I'm long 2 or 3 lots, 2 or 3 contracts, that's it. I'm just either going to be stopped out with those 2 or 3 contracts, or I'm exiting all of them in full at my standard exit point. Now, the other main thing that you should be, looking for is that only use this if you are anticipating a large move. This is not going to work if you just want to make a quick trade. You know, if you're looking for a quick pop, don't use this technique. This should be used when you feel that the market has kind of been coiling and being ready to really just break out and go in a direction, and then you get a signal with one of our strategies, and then you think, boy, this thing's going to really take off, either up or down, because you can use this going on a downward move as well. So use this when you really feel there's a large move, you anticipate a large move in the market, okay? We cannot stress enough, though, always exit everything at the 400% level. Exit your full position there, okay? Because many times the trend will end, almost magically end at the 400% range extension level. And then lastly, I cannot stress this also enough, you must be adequately capitalized. This will seem fantastic once you try this and it works once or twice, but you could have a series of losing trades, and you know, it's one thing when you have a series of losing trades trading one lot, but But you have a series of losing trades. When you're trading 3 lots, it can get very expensive. So you must have enough capital in your account to be able to withstand some type of drawdown if you're going to be using this. Okay, in conclusion here, we talked about how to add to your position size, but the only way this technique will work is if you really know the strategy like the back of your hand, regardless of which strategy you're using. If you're using strategy 5 or 6, 1 or 4, it doesn't really matter, because this technique will not work if you really fully do not understand where your proper entry should be, where your proper stop placement should be, what it's based off of, how to find the setup bar. So you have to learn these things first before you use an add-on technique such as the position size method we just showed you today. So the way to learn is not by simply jumping in, but by paper trading first. Watch the videos as often as possible and then paper trade. Paper trade for a month, 2 months, it doesn't matter, just as long as you fully understand the strategy, and then you can start to begin to add on techniques such as this. Our edge here is consistency. We're not looking to get home runs. We're looking to get consistency in our trading, and the only way you can do that is by properly understanding the process behind each and every strategy that you're using. Now, if you have any questions concerning what I went over today or anything on the website, please do not hesitate to email me at stephenprimo@specialisttrading.com. In closing, I ask